Jai Hind everyone. Welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge, etc. Today I'm going to describe about 10 common mistakes found in AIS Annual Information Statement and how to fix them, a complete guide for taxpayers. Introduction. The Annual Information Statement (AIS) is one of the most valuable tools introduced by the Income Tax Department to help taxpayers view a comprehensive summary of their financial transactions in a financial year. It contains information relating to income tax deducted at source (TDS), tax collected at source (TCS), interest earned, dividends, securities transactions, property purchases, mutual fund investments, foreign remittances, and many other financial activities sub reported by banks, employers, financial institutions, mutual funds, registrars, and other reporting entities. Introduction. While AIS has significantly improved transparency and simplified income tax return filing, it is important to remember that AIS is only an information statement and not the final authority for filing your income tax return. Since the information is collected from multiple reporting sources, there may occasionally be delays, omissions, duplicate entries, incorrect reporting, or mapping errors. Therefore, every taxpayer should carefully reconcile AIS with Form 26AS, Form 16 or 16A, bank statements, capital gain statements, dividend reports, and other financial records before filing the income tax return. Understanding the common mistakes found in EIS can help avoid notices, incorrect tax payments, or delayed refunds. First, missing income entries. One of the most common issues observed in AIS is that certain income may not appear in the statement. This can happen because the reporting institution has not yet uploaded the information, submitted incorrect details, or reported the transaction after the AIS was generated. Examples include interest income, professional receipts, salary details, or certain investment incomes that are yet to be reflected. Many taxpayers mistakenly assume that if income does not appear in EIS, it does not need to be reported in the income tax return. This assumption can lead to incorrect return filing and possible tax notices later. The correct approach is to compare EIS with Form 26AS, Form 16 or Form 16A, bank statements, interest certificates, and all other income records. Every taxable income must be reported in the ITR even if it is temporarily missing from AIS. Second, incorrect interest income. Interest earned from savings accounts, fixed deposits in FDs, recurring deposits, RDs, corporate deposits, or other interest-bearing investments may sometimes even be reported incorrectly in AIS. The amount shown may be lower or higher, duplicated, or missing due to reporting differences by banks or financial institutions. Since interest income is fully reportable under the Income Tax Act, subject to applicable deductions, incorrect reporting can result in under reporting over reporting of income. Taxpayers should carefully verify all interest in certificates issued by banks, financial institutions, and post offices. The actual interest earned during the financial year should be correctly disclosed while filing the income tax return, irrespective of any reporting discrepancy in AIS. Third, wrong TDS details. Tax deducted at source TDS is another area where discrepancies may arise. Sometimes the deductor reports an incorrect amount, an incorrect PAN, the wrong financial year, or an incorrect section under which tax has been deducted. If TDS details are incorrect and inaccurate, taxpayers may receive less credit than they are entitled to, which may increase their tax liability or delay their refund. To avoid such issues, taxpayers should cross-check EIS with Form 26AS, Form 16, Form 16A, salary records, and TDS certificates. If any mismatch is found, the taxpayer should immediately contact the deductor and request correction through the prescribed TDS correction process. Fourth, duplicate transactions. Occasionally, the same financial transaction may appear more than once in AIS. Duplicate reporting can occur if more than one reporting entity submits the same information or due to technical reporting issues. Duplicate entries may artificially increase reported income or financial transactions, resulting in confusion while filing the return. Taxpayers should compare duplicate entries with their bank statements, contact notes, investment records, and supporting documents if duplication is confirmed. Appropriate feedback should be submitted through the income tax e-filing portal so that the discrepancy can be reviewed by the department. Fifth, high value transactions you do not recognize. EIS may contain information relating to high value purchases, investments, deposits, property transactions, or other in financial activities that taxpayers do not recognize. Such entries may arise because of reporting mistakes, pan mapping errors, or transactions involving joint holders. Ignoring such entries may become problematic if they are later considered unexplained during assessment proceedings. Therefore, taxpayers should immediately verify these transactions with their own records. If the information is found to be incorrect, suitable feedback should be submitted to the AIS portal so that the discrepancy can be examined or and corrected. 6. Incorrect capital gain information. Capital gains relating to shares, mutual funds, bonds, and other securities are another area where AIS may not always perfectly match actual tax computation. AIS generally reflects transaction level information received from reporting entities, but it may not accurately calculate taxable capital gains after considering acquisition costs, grandfathering provisions, indexation benefits, bonus shares, rights issues, corporate actions, or carried forward losses. Hence, taxpayers should always rely on the capital gain statement provided by their broker, mutual fund platform, or investment intermediary and compute capital gains strictly according to the provisions of the Income Tax Act before filing their return. 7. Wrong personal details. Incorrect information is another possible issue in AIS. In some situations, reporting errors, incorrect PAN mapping, or mistakes made by reporting institutions may associate another person's transaction with your PAN. Such errors can lead to inaccurate reporting of income, investments, or financial transactions. Taxpayers should carefully review every entry appearing in AIS. If any transaction does not belong to them, feedback should immediately be submitted through the AIS portal so that the information can be investigated and corrected by the reporting authority. 8. Missing dividend income. Dividend income received from companies, mutual funds, or other investments may sometimes be missing or only partially reflected in EIS because reporting by the concerned company or registrar has not yet been completed. Since the dividend income is taxable according to the applicable provisions of the Income Tax Act, taxpayers should not rely on AIS while reporting dividend income. Instead, they should verify dividend credits through Demat account statements, dividend reports issued by registrars, broker statements, and bank account credits before filing the income tax return. Ninth, reporting delays. AIS is updated continuously as financial institutions submit information to the income tax. Therefore, it is possible that certain transactions are not reflected when AIS is first generated but appear later after fresh reporting. Filing the return based on an outdated AIS may result in incomplete reporting. To minimize such risks, taxpayers should download the latest version of AIS, particularly close to the due date of filing the income tax return. Reviewing the most recent AIS helps ensure that all available information has been considered. 10th, assuming AIS is the final source of truth. Perhaps the biggest mistake made by taxpayers is believing that AIS alone is sufficient for filing the income tax return. AIS is an excellent information tool, but it is not a substitute for personal financial records. It may contain omissions, delays, duplicate entries, or reporting errors because the information depends on multiple reporting entities. The income tax return should always be prepared for comparing AIS with Form 26AS, Form 16 or Form 16A, salary slips, bank statements, capital gain statements, dividend reports, investment proofs, interest certificates, and all other supporting financial documents. Final checklist before filing your income tax return. Before submitting your income tax return, every taxpayer should complete the following important checks. Review the AIS thoroughly from beginning to end. Match every relevant entry from Form 26AS. Verify all TDS credits. Ensure every source of taxable income has been reported. Check savings account and fixed deposit interest carefully. Verify dividend income from all investments. Review capital gains using the broker's capital gain statement. Remove or report duplicate or incorrect entries. Submit feedback for discrepancies through the AIS portal wherever when necessary. Download and review the latest AIS before final submission of the income tax return. Following this checklist can significantly reduce the chances of filing errors, tax notices, mismatches, delayed refunds, or additional tax demands. Conclusion: the annual information statement has transformed tax compliance by providing taxpayers with a consolidated view of their financial information. It promotes greater transparency and helps taxpayers prepare more accurately income tax returns. However, since AI is generated using data reported by various organizations, occasional inaccuracies omissions and reporting delays are possible. The safest approach is to treat AIS as a valuable reference tool rather than the sole basis for tax filing. Careful reconciliation with Form 26 AS, salary records, bank statements, investment reports, capital gain statements, dividend reports, and other supporting documents ensures an accurate filing, reporting, and compliance with income tax. Spending a little extra time reviewing AIS filing can save taxpayers from future disputes, notices, and unnecessary stress while ensuring a smooth return filing experience. Disclaimer: this article is intended solely for general educational and informational purposes. The information presented is based on commonly observed AIS reporting scenarios and should not be considered legal, tax, accounting, or financial advice. AIS data is subject to updates and corrections by reporting entities, and the Income Tax Department may revise or modify the information from time to time. Taxpayers should verify AIS with Form 26 AS, Form 16 or 16A, bank statements, capital gain statements, dividend reports, and other supporting financial records before filing their income tax return. In case of complex tax matters, significant discrepancies, and uncertainty regarding tax treatment, readers are advised to consult a qualified tax chartered accountant, tax practitioner, or financial advisor, and refer to the latest provisions of the Income Tax Act, applicable rules, and other notifications issued by the Income Tax Department of India. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.